Hello and good morning, folks. We are right after the FOMC and one of the widely watched central bank meeting influencing the directions of the financial markets. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Shikhar Garg, and let's dive right into the FOMC updates. Fed Chair Jay Powell did increase the rates by 75 basis points as it was widely anticipated by the market, but it was the forward guidance which stole the show. Mr. Powell admitting that the interest rates as a tool works with lag and is kept under consideration while reduction in the pace can be a little premature to say that there are reductions in the rate hike pace. I must give it to Mr. Powell for showing some glimpses of the Volcker like resilience, keeping 2% inflation as the target. Now JK, I believe it's gonna be an event which is having wide repercussions and influences. So I'd like you to give me a very good detailed update on what do you think and what should we be expecting.
Hey, good morning, Shikhar. So Fed really disappointed the pivot crowd who had interpreted the recent indications through media too much to the dovish side. But what we got in the end was a continuation of central bank's focus on inflation fight and nowhere an indication of a pause. The key statement from the Fed itself while announcing the rate hike was that in determining pace of future increases in target range, committee will take into account cumulative tightening of monetary policy, lags with which monetary policy affects economic activity, inflation, and economic and financial development. And this was interpreted to mean confirmation of markets expectation that central bank will be pivoting, resulting in rally in stocks, bonds, and currencies. But the perception changed after Powell's opening remarks in his press conference, and more so during his Q&A. While making clear that Fed would take forceful steps to moderate demand, he said the data suggested ultimate level of interest rates will be higher than previously expected. And there existed a significant amount of uncertainties around the level of interest rate and to take time for full effects of policy to take effect, particularly on inflation. It will also at some point become appropriate to slow the pace of rate hikes. Yes, now the pace of rate hikes might be slowed, but the ultimate target rate for Fed might be much higher than what was even discussed during September. So he was saying that terminal rate is not done, understood, and still evolving. That really settled the market's understanding and the realization that we were far from a pivot and reversed most of the moves seen earlier. Powell saying that data suggested we may ultimately move higher to higher levels than we thought in September was a nail on the coffin for a pivot-seeking crowd. Even the chairman clearly said it was too early to talk about a pause. Also, Powell reiterated that more than pace of rate hikes, it was important to determine how high the rates went and how long that will stay so that the inflation at 2% is achieved. He was very clear that speed was becoming less important. And the slowing rate hikes may come as early as December or even the Feb meeting. That is what he was saying. My interpretation is that it's a clearly increased hawkishness than seen so far, an indication of rates going higher than earlier thought. And the final terminal rate will be open to market's interpretation. Fed is clearly not taking chances in their fight against inflation. And also, from the way he sounded in his remarks, it appears that he doesn't want the market to take any dovish expectations as long as the inflation remains so high so that the financial conditions are loosened, and again that adds to the inflation. So he's very clear in their approach, and it is not a departure from the previous meetings. It's just that he had to clarify to the market that Fed is not deviating from its goal, and possibly the approach would be slightly moderated through lower pace of rate hikes, but nowhere near the pause. That is the takeaway from this. And right now, if you look at the US economy, it is giving a mixed picture, with some sectors like housing and manufacturing taking a downturn, while employment is holding up extremely well with high job creation and employment rate at record lows. Even GDP is holding up well. All this means that even if December rate hike, even if it is 0.25, does not mean that focus that we are closer to ending of the rate. The terminal rate will be shifting up and will stay higher for longer. So the stocks obviously which tried to rally after the initial statement, and now they're clearly perceiving financial conditions tightening more, and that will have an adverse effect on earnings going forward. This is what the market perceived after his presser, and sold stocks heavily. Nasdaq nosediving 3.5% and S&P 500 2.5%, with Dow a much lesser 1.55%. And this is the third consecutive day of fall in stocks. And when I look at the technicals, it could be a start of a fresh bear market in the stocks. Yields also soared across the curve, with the 2-year reaching 4.64 from 4.4, 10s from 3.97 to 4.11. Yield curve has steepened to more than 50 points as of now. And that means the market is starting to discount even a greater probability of a recession going forward. The Fed Watch tool shows 56.8% probability of a 50 basis point hike in December, while 75 basis point has got 43.2% chances. US dollar, after a volatile session, rallied, posting third successive day of gain. However, it's not too far from the highs we had seen during the Asian trading yesterday. In fact, dollar yen is at the middle of yesterday's range, and even lower from the closing levels of New York. Higher yields and prospects of terminal rate going higher than earlier thought will keep the dollar buoyant for now. Future markets are divided on how high the Fed will raise on December 13th and 14th. He did refer to a stronger dollar being a challenge for some of the countries, but that does not mean that it is even a minuscule factor in their decision yesterday. I expect dollar strength to be in place, but with less momentum, as the positioning is quite heavily to the long side, and matching rate hikes by other central banks will also neutralize a dollar strength to some extent. So we keep watching how this other central banks behave and other economies also perform going forward. On the economic data, we had PMIs from Europe, which was weak again. But on the positive side for Europe, the German trade went into a surplus, and the unemployment rate was steady at 3%. US employment picture continues to show strength as private job creation, as per AVP data, rose by 239,000 versus expectation of 195,000. Investors will get more look at the labor market in the form of weekly jobless claims today and October payroll report tomorrow. Let's not forget that UK Central Bank is meeting today. Rate hike of 0.75%, a record hike after many decades, is on the cards. The central bank statement will be the focus, as it could give hints about medium-term fiscal plan that the government will be presenting on November 17th. Also, as per statements from Lagarde recently, they will be going for rate hikes in the more upcoming meetings, and this has mellowed down the dovish interpretations that emerged after the last ECB meeting. Coming to rupee, we had stated yesterday that stakeholders on the rupee were more on the cautious side ahead of Fed meet, and rupee traded not too far from recent highs, as demand continued to outstrip natural supplies, necessitating more intervention. Fed's continued hawkishness and high uncertainty about how high the rates will go in the US, as well as Fed's rally in the dollar index, will again keep the rupee's weak tone intact. Therefore, only a matter of time before the previous all-time high of 83.25 is tested, with a break imminent as and when the central bank pauses in its supplies. With overall conditions favoring a stronger dollar and its own reserves depleting steadily, RBI will be aligned with further weakness in the rupee if it is accompanied by a dollar index strength. At the same time, prospects of higher imported inflation and the need to avoid a gap with US rates widening too far, more policy rate hikes may be on the cards from RBI as well. we do have RBI special meeting today, an unscheduled meeting of the rate setting panel. It's reportedly intended to prepare the report to the government explaining why the inflation has exceeded the upper band for 3 consecutive quarters and will possibly put a timeline to fall back within the band. This may hint about the future rate decisions by the central bank. While the report may not be immediately available as per RBI governor statement, this will not be, this will be made public eventually. So let's hear out RBI today. But overall, the course for the rupee is not changing. Dollar overall is continuing to be stronger, and risk assets are likely to be on the weaker side, at least for a few more sessions. Thank you.
Okay, JK, and that was, as I requested, quite detailed, and I really enjoy listening to all the updates from you. It's quite good, thoroughly watched out, and studied. That's what impresses me. So, folks, as JK mentioned, the pace might be slow, but the terminal rates would be higher than what was expected, is something Mr. J. Powell mentioned, making the pace a little less important comparatively, and putting emphasis on the terminal rates, which people must be looking for now, while earlier it was the pace which was much more important for a lot many people in the financial markets. But one more thing that they mentioned was the pause is nowhere near. So with this statement, there was a huge round of volatility last night, only to end off with a risk of mood. Just before we end, folks, there is the UK, or the UK central bank meeting today, with another 75 basis point hike by a central bank today. And this, what makes this interesting would be the biggest hike by the BOE in decades is this 75 basis point hike which they might come up with. So there's a lot of things going on in the financial markets, folks, and the risk reasons or the risk concerns have not yet been stymied or taken care of. So I hope you guys are managing your risk. We'll come up with another round of updates for you tomorrow morning. Till then, happy trading and managing your risk. Thank you so much for listening.